All right. So if you'd like to revisit this information, I believe I can send you a link. Just reply to the email you got to join this webinar, and I can send you a link if you'd like to view the recording. It takes a little bit of time for us to get the recording through compliance, and that's when we can mass email it out. But I think I believe we can send it to you one-on-one if you'd like to revisit some of the topics we cover. And I have to put a few disclosures up on the screen before we dive in to the important topics that you came here for. So we've disabled chat features. Again, this will be recorded. If you have questions, there are over 100 folks logged in that I can see. So if you have questions, there's too many to take questions directly. If you have questions, just reply to the email that you got to join this call, and I'll personally respond, usually within 1 business day. So feel free to type your question in there, or if you don't want to type out a big long email, you can call our office at 630-232-8995. Again, 630-232-8995. We'll get right back to you. Again, you could reply to the email as well. Just say, hey, I'd like an appointment with Kevin or one of the advisors over there. I've got some questions. We're happy to talk to you that way. Okay. Getting into our agenda, briefly going to recap what we covered last month. We covered the 3 critical topics to address, or the 3 critical steps to take before your last day on payroll, right? If you're on the union side of the fence and you are part of the enhanced SIP offer, that might be July 17th for you. I know many of you are probably still waiting for confirmation if you were accepted. On the management side of the fence, I know there's a lot of rumors. The dates are a bit less concrete over on the management side of things, but there may be some headcount reduction activity in the next month or 2. Same thing, these same steps apply to you as well. We might not have the date yet, right? We might not have a firm date, or maybe you're just planning to retire on your own terms. Same steps apply, okay? So if you're union, you're gonna be off payroll on July 17th, good idea to get these steps taken care of before that date. If you're management and you're planning to retire anyways, or you expect some type of headcount reduction efforts over the next month or 2, these are great steps to take as well. And the first one is just confirm you can afford to retire, whatever that means for you. It might be retire completely, right? You don't go back to work in any capacity, or it might mean that you take a job somewhere else other than AT&T, maybe a part-time job, right? Maybe you don't want to work as much or as hard as you are right now, particularly on the union side. Maybe you want to do something less physical. We can help you think about all that. And we use a tool that we like to call our retirement map. I won't go into as much detail as I did last month, but it gives you a score effectively, right? A probability of success. What are we trying to do? We're trying to avoid running out of money, right? We want to have a reasonable lifestyle, maybe replicate the income we have today from working, but from our portfolio and from Social Security and from other sources, right? So what's our probability of success? So we can sum that up in a number, which is kind of nice. This is an example, right? You have $1 million portfolio. Maybe that's a combination of 401k plus pension lump sum, maybe some other savings that you may have. We're retiring this year, 2020, for example. Maybe we're trying to produce $5,000 a month before tax. After tax, maybe that looks like $4,000 a month in our pocket, right? We have to account for taxes since so much of your retirement money's not been taxed before. In this example, we've got someone born in 1960, living to 90 years old. So it's a 30-year plan. And we're trying to get a 2% raise every year, right? So our $5,000 a month goes up by 2%. Take some Social Security out here at age 62, for example. We can help you think about that. When to claim Social Security, it's an important decision and a more complicated one than it may appear on the surface. And in this example, 86% probability of success. Is it 100? No, we're not going to get to 100. But our system only goes as high as 95 because nothing in life is certain, of course. So 86 is pretty good. And then with folks that we engage after retirement, we'll monitor this, right? So if the 86% starts trending in the wrong direction, right? Because we update this exercise, say every 6 to 12 months, and our 86 becomes 80 and then becomes 75. Well, we've got to make some adjustments, right? We're trending in the wrong direction. Alternatively, if our 86% remains stable, well, good. Everything's going according to plan. If our 86 starts trending up, our 86% becomes 90, becomes 95, we might nudge you to go spend some money, go take a vacation, right? That's the fun part. That's a happy problem, okay? So confirm you can afford to retire. What does retirement look like? Do you have to go back to work? Hopefully not. If you do, maybe just not doing something that's a little more fun, not quite as time consuming, okay? So that's the first critical step before you're off payroll. Can I afford this? Can I afford to do this? Second thing, generate your pension modeling statement. This is a big one. This can be done through the Fidelity website most easily for the vast majority of you. So you've probably seen this login screen before, right? Won't log in today because we're not an AT&T employee, but each of you has a login, and you can walk through a process to estimate what your pension benefit or benefits may be. And in fact, we're going to look at a live set of pension benefits here in a moment when we get to the meat of our discussion, which is the interest rate game, right? Do we wait to claim our pension because maybe it goes up a bunch like it did this year due to movements in interest rates? So we'll look at a live set of estimates here in a moment, but generating these estimates ahead of time is really important. So if you're going to be off payroll on July 17th, for example, you would plug in your last day of employment, July 17th, and then the start date might be August 1st, for example, if you're on the union side of the fence, right? At the beginning of the next month. Some management employees can claim right away, same day, okay? So take a look at those estimates. We can help you navigate all that again in a one-on-one setting. We'll share our screen just like this, except for it'll be your information on the screen, one-on-one, okay? A very small percentage of you have to call to get estimates. Do that sooner rather than later, because it takes Fidelity about 2 weeks sometimes if they have to hand calculate your estimates, which again applies to a small percentage of you. It takes them about 2 weeks. So get a jump start on that particular activity if you're unable to run the estimates online. So that's the second critical step. Generate your pension modeling statement based on your last day on payroll and your anticipated start date. We're going to look at a live set of estimates here in a moment. If you do have to call Fidelity for estimates, 800-416-2363. Again, 800-416-2363. That's where you get started. They might redirect you from there. That's where you get started, okay? And then last but not least, this is a big one. Call the AT&T Benefit Center to confirm how your medical coverage will work as a retiree. This is a really big deal, okay? Your medical benefits are critical. So if you make that rule of 75, you are medical coverage eligible. In most cases, there are some managers that I know can run into some issues if they started after a certain date, but 877-722-0020. If you are on the union side of the fence, your medical coverage benefits probably won't change, not until the next contract in 2022. So you're just kind of confirming, hey, making sure I'm going to be transitioning over to retiree status here pretty soon. Give them the date if you have one, July 17th, and make sure that you, your spouse, any dependents are still covered. Your cost, again, if you're on the union side, your costs should remain the same. The only thing you're changing on the union side is how you're paying those premiums, right? Because you no longer have paychecks to deduct those premiums from. You've retired from the company. So you'll want to make arrangements with the benefits center to have those premiums deducted from your checking account going forward. Really easy to do. But automate that. You don't want to be navigating bills every month, and what if you forget? Automate it. So that's what you do on the union side of the fence. On the management side of the fence, it's a little more involved. It's a little more involved because you are transitioning to retiree coverage, and it takes a little bit of time. I went through this with a manager within the last month, and the process is a little convoluted, right? So you retire. Let's say your retirement date was the middle of June in this example. HR then has to notify the benefit center, which takes some time. The benefit center then has to notify the insurance company. This is for managers I'm talking about, okay? That takes some time. So they have to notify Blue Cross Blue Shield, for example, if you use Blue Cross Blue Shield's coverage. That takes some time. So there can be a little bit of a window there where you're kind of in limbo And you want to get this process moving as fast as you can. Because if you use healthcare services during that window while you're kind of transitioning from active status to retiree status, it can be a little bit of a nuisance. Sometimes you got to keep track of your costs because your card might get rejected until they've sent you a new one. You got to keep track of your costs, get reimbursed for it. So it's a little bit of a nuisance. Important to stay on top of it. And again, if you're on the management side, your costs, your premium costs are probably going to change a little bit. So you want to confirm what those are, confirm you can afford them, confirm you're comfortable with them, especially if other folks depend on you, right? Spouse, dependents, etc. Okay, so that's really, really important. And that's something we can, we can obviously kind of help you navigate, but the Benefit Center is the place to go, 877-722-0020. All right, good. So those are our 3 critical steps to take before your last day on payroll that we talked about last time. Confirm you can afford to retire. We can help you do that in a one-on-one setting like this. We can do a Zoom meeting like this one. It's secure. Okay, the password secured. Number 2, generate your pension modeling statement based on your last day on payroll. We're going to review some real estimates in a second. And last but not least, call the Benefit Center. Ensure there's a smooth handoff with respect to your medical coverage from active status to retired status. It's really easy on the union side. It's a little bit sticky sometimes on the management side. Okay, so you want to stay on top of that. It's important. All right. Let's move on to the really important topic. And the reason we decided to have this webinar, by the way, so I was just getting a lot of questions about this topic. And it seemed like a lot of folks were interested in the interest rate game because you probably observed how much your pension lump sum went up from last year to this year. And you're wondering if that's going to happen again. And is there a benefit to waiting? So even if I'm off payroll in July, should I wait until January of 2021 before I actually claim my pension? Is it worthwhile to play that interest rate game? And it's a really good question. It's a valid question. For most of you, it's probably a $10,000 to $20,000 question based on where rates are right now. So we're going to talk about that in great detail. Okay, and that's probably the topic you're most interested in today. And then we'll leave you guys alone for a while. We won't bother you with any webinars or anything like that. We're just getting a lot of questions about this topic and figured it might be good to review it. Okay, so the place we always like to start, the IRS website, irs.gov, specifically the minimum present value segment rates. There are a whole boatload of interest rates that you hear tossed around in the financial media. For your pension lump sum, these are the ones that matter. Okay, the minimum present value segment rates. And the IRS publishes these on a monthly basis. What's instructive is that we're sitting here on July 8th, and what do you notice right away? We don't have the June rates yet. I'd expect them to be out by next week. So if you're on the union side of the fence and you're going to be off payroll on July 17th, hopefully we'll have the June rates by then. Not that the June rates matter all that much. It's an additional data point to help us make our decision. But remember, it's the November rates that matter. So when you run pension estimates, again, we're going to look at a live set in a second here. Those pension estimates are based on the November of 2019 rates if you claim your lump sum during calendar year 2020. Okay. We're not going to know what the November of 2020 rates are until mid-December. So if we decide to play the interest rate game, in order to know with certainty what our pension lump sum will be if we indeed wait until January to claim it, right? Because you can defer. You can be off payroll in July, for example, and you can defer claiming the pension until January 1st if you want to. You can even defer longer than that. We can debate whether or not you'd want to. That's a good discussion for us to have. I think for the purpose of today's conversation, we're just deciding between, all right, do I claim the day I'm off payroll immediately, or do I wait until January 1st of 2021? I think that's the conversation we're having today. Yes, you can defer longer. There's some risk to doing so. We'll get to that. I think we just kind of assume we're claiming on one of two dates, the day we're off payroll or January 1st. We won't know what the November rates are until late December. So for now, we're just speculating. we can see that the rates as of May are lower than the rates were last November. That is good for your lump sum. That means that if we fast forward and we're sitting here in late December and the November 2020 rates are the exact same as they are today, or as of May, I should say, that's good for your lump sum. It's good for your lump sum. For most of you, that means your lump sum is probably $15,000 to $20,000 higher. Okay. And we're going to look at some live estimates in a second. So let's pull up those live estimates. All right. So we stripped out all the personal information here. This happens to be a union pension. So your numbers might be different, right? Depending on your pay scale, union or management, how old you are, what your wages look like. All that stuff goes into the pie. So this is just one specific set of estimates, and you may have seen this screen before. Fidelity allows you to run as many as 3 scenarios. We're just going to focus on 2, right? In this case, it's a union employee who stops working on July 17th. Okay. And scenario 1 shows a benefit commencement date. It's the same day as the last day on payroll, July 17th. All right, so commence right away. If you are a union employee, when you actually go to initiate, you might find that the date here shows August 1st. Sometimes they kick you out to the first day of the following month. That's okay. Doesn't change anything. Might mean you have to wait a little longer to receive your lump sum. That's okay. The lump sum, it takes time to get it. Count on 4 to 8 weeks. Fidelity sends you a physical check for it, which is a little disconcerting, but the check, that's how they do it. There's not an electronic option. But the check is payable to your IRA account. So presumably during that 4 to 8 weeks, you take steps to set up an IRA, whether it's with us, on your own, whatever the case may be. A lot of times folks will kind of choose between self-directing or working with a firm like ours. You can stay with Fidelity. That's a good option. Fidelity is a good company. They've got good low-cost options, but their advisors are incentivized to sell you Fidelity stuff, right? They have their own products. We don't. We're fiduciaries. We just sell it. We have advice. Advice is our product. We don't have insurance products or anything to sell you for a commission. That's not how we work. So it's kind of a matter of thinking about what type of experience, what type of incentive model you want the advisor you're working with to have. So do you want fiduciaries? Do you want tax advice? Right? We have a tax firm. We have CPAs, so we can give you tax advice. Those are all factors to consider. Okay, you're not going to get tax advice from a place like Fidelity, for example. So scenario 2, still off payroll July 17th, but now we wait until January 1st to claim. All right. So that's the distinguishing characteristic. We're waiting, in this example, 5 to 6 months before we claim our pension. Now you'll notice that we've plugged in the May 2021 rates. Excuse me, May 2020 rates. Okay. So scenario 1 is using the November of 19 rates. Scenario 2 is using the May of 20 rates. Okay. Let's take a look at what happens to our lump sums. So in this example, scenario 1, off payroll July 17th, claim right away. Lump sum is about $525,000. Scenario 2, off payroll July 17th, wait until January 1st, assumes rates stay as low as they are right now. That's a big one, okay? So this 525, that's a guaranteed number. Assuming this person is indeed off payroll on July 17th, that's a guaranteed number. We know what it is. The 539 and change, that is not a guaranteed number. Interest rates would have to stay where they are as of May by the end of this year. Interest rates would have to stay where they are. If interest rates go up from here, which they certainly could, your guess is as good as mine. If interest rates go up from here, as they did in March, frankly, when the world was getting a little crazy in March, interest rates went up. This lump sum is going to go down. Okay, so you could end up with a lump sum that's 530 or 520 if interest rates go way up, right? It could work against us. So this 539 is not guaranteed. That's why we kind of call it playing the interest rate game. We're making an educated guess. If this person's off payroll July 17th, hopefully we'll have one more data point upon which to base that guess, right? We'll have the June 2020 interest rates, but it's still just an educated guess at this point. There's a lot of things that can happen between now and November. Okay. This deferred lump sum, okay, it's $4,000 or $5,000 less in scenario one. Why is that? Well, there's a cost to playing the interest rate game, right? It's not a free ride. So if we end up waiting until the end of December, the very end of December, let's say, so we're sitting here on December 31st, and we look at the November rates, and we say, you know what, the November rates, they're higher than they were last November. I've got to take my pension today. I don't want to wait until January, because if my pension's calculated using those higher interest rates, and my lump sum's going to go down. Well, we cost ourselves $4,000 or $5,000 by waiting until the end of the year. So there is a cost to playing this game. The pension lump sum kind of erodes, for lack of a better term, because of how it's calculated, right? The pension lump sum is kind of a theoretical, it's a present value of the hypothetical annuity payments you could have received over the rest of your life. And if you wait, that's fewer months of hypothetical payments, right? Because the actuaries behind the pension are kind of making an assumption as to how long you'll live. And if some months go by, well, there's fewer months of life expectancy there, right? So the pension lump sum goes down a little bit. So there is a cost to waiting. The pension lump sum erodes, okay? There's some annuity estimates down here. We can talk in great detail. Everybody's different, right? So there's no right or wrong answer in terms of choosing between lump sum and annuity. This is different from an annuity sold to you by an insurance company. That's really, really important, okay? Payout tends to be a little bit higher. Insurance companies have to make a profit, right? So when you buy an annuity from an insurance company, there's some profit baked in. The person who sold it to you gets paid out of that profit. So just know this is different. This is a different annuity than something you would buy from an insurance company, because the pension doesn't have to operate at a profit, right? So it's a little bit different, okay? Good. You know, I just got a good email here. So when you turn 60, after you turn, this is a good point. When you turn 65, at that point, you know, there's lots of reasons why you will have wanted to take your pension before then, but that's a good point. Once you've turned 65, you don't have the option to defer your pension. Okay. You probably will have wanted to take it before then anyways, but that's a good point. So thank you for sending that in. I just got this email now. Okay, good. All right, interest rates don't affect the annuity amounts. Okay, so the interest rate conversation is really just about the lump sum, which probably 70 or 80% of folks are taking the lump sum these days. One, just because it's really high. Okay, interest rates are so low that the lump sum amount is really high. And what that means is we can reasonably, recreate this monthly annuity amount. It's not impossible, while still giving you control over the rest of the money, maybe giving you a raise if the investments perform reasonably well. That's not something you can accomplish with the annuity, right? Once you start receiving the annuity, that's it. That amount is not going to go up. So in this case, it's about $2,500 a month for single life, right? Just on the life of the AT&T employee. That amount will not go up over time. So $2,500 is a lot of money today. Be nice to have. But 30 years from now, $2,500 is not going to have the same purchasing power that it does today. So if you want the ability to kind of get a raise each year, to keep pace with inflation, the loss of purchasing power, right? Prices go up. The prices of the stuff we need to buy go up. So that's something that's only possible with the lump sum. Possible, not guaranteed, right? Just possible or reasonable. And that's a big reason why folks choose the lump sum. The other big reason folks might choose the lump sum, if you have a non-spousal beneficiary, so maybe you're not married, maybe you have kids, maybe you have grandkids, a charitable interest, whatever the case may be, a friend, family member, someone who's not your spouse, that you would ultimately like to see some of this money go to when you're gone, that's only possible under the lump sum. Okay. Folks who choose the annuity might do so because they don't like the stock market. That's the last thing we're going to talk about in a moment here. I don't like the volatility, the ups and downs. I can't deal with it. Just give me something guaranteed. Folks like that might choose the annuity. If you live a good long life, and when I say a good long life, I mean, well into your 80s or 90s. You or your spouse, right? If you take the 100% survivor option, which in this example is about 2,000, right? Instead of 2,500. So you're giving up about 500 a month to cover a spouse in this example. It's probably equivalent to earning like 3 to 5% on your money, somewhere on there, around there. We can run that calculation for you, kind of show you what the kind of equivalent rate of return is, what you would have to earn on the investments that you buy with the lump sum in order to at least recreate the annuity. We can help you think about that. For most folks, it ends up being kind of 3 to 5%, which, hey, 3 to 5% on a guaranteed basis right now, it's pretty good. It's more than your bank's giving you, to be sure. So that's not bad. But it's reasonable to assume you could do better by taking the lump sum, investing it reasonably, based on many years of stock market history. Okay. But not guaranteed, right? Not guaranteed. So that's important to reinforce. Okay. So hopefully that was helpful. I think the key takeaway here is that if you're going to play the interest rate game, there is a potential cost involved. There's risk involved. The one I didn't mention is, you probably don't want to pass away while you're playing the interest rate game, as your beneficiary is going to get a lot less in all likelihood than the numbers you see here. Okay. So there are some risks involved, right? Because the lump sum kind of erodes over time. Some folks might say, you know what, give me the 525 now, I'll invest it, and maybe my investments will perform in such a way that my 525 is going to grow to 540 anyways. It's about a 2 to 3% rate of return over the next 5 to 6 months. That is not guaranteed, but not unreasonable either. So some folks might say, again, give me control of the lump sum now, I'll invest it in a way that I'm comfortable with, and hopefully those investments will perform in such a way that my 525 ends up growing to 540 anyways. Okay. So good. So again, happy to schedule something to review your specific estimates if we haven't already. Okay. Last but not least, let's give you a quick update on the stock market, how things are looking over there. This is relevant to the lump sum, right? Because once you receive that lump sum, you've got to do something with the money. You've got to invest it somehow. So the level of the stock market matters a lot. And if you choose to play the interest rate game, so you're off payroll in July, for example, you're going to wait the rest of the year before you actually claim your lump sum. What if we're sitting here in September or October ahead of the election and the stock market goes way down like it did in March? Stock market goes down 25%. I hope not. I don't know if I can take that again, but let's say the stock market goes down. That might be a pretty good time to claim your lump sum, because maybe you say, you know what, forget the interest rate game. I've got an opportunity to buy stocks while they're on sale. Stock market just went down 25%. So that's a factor to consider. That's something to think about. So you're going to want to, if you're going to play the interest rate game, you might want to monitor the stock market between now and the end of the year, because if there's a big dip, that might be a good buying opportunity. Okay, so that's another factor to consider. All right, so what you see on the screen here, went over this a little bit last month. This is called Morningstar's Fair Value Estimate. So what the heck does that mean? Morningstar is a company that coincidentally is based in downtown Chicago, but is global in reach. And our chief investment officer, Brian Dorn, who some of you may know, used to work there. So we're very, very familiar with Morningstar's research. And Morningstar covers, they have human beings, human analysts, that cover about 1,500 publicly traded companies. So Morningstar wraps up its estimates of what it thinks those 1,500 companies are worth. It wraps all of those estimates up into one big estimate that it kind of considers to be the overall market. So this is all 1,500 stocks that Morningstar covers. And then compares those estimates of what Morningstar thinks the stocks are worth to the prices those stocks are trading at today, and comes up with a ratio. They update this ratio every day. Right now, the ratio is 1.02. So what does that mean? That means that stock prices, as we sit here today, are probably a little higher than they should be. They're probably a touch higher than what Morningstar thinks those stocks are actually worth based on their business fundamentals in this environment. Okay, doesn't mean we're going to have a big crash or anything like that. It's always possible, but this ratio doesn't seem to point to that. Might be a little bit of a correction, right? We had kind of a down day yesterday, for example. But if I extend, let me refresh this and see if it'll give us year to date. The ratio got really interesting in March. So if we look at, hopefully I can update this chart to year to date here. Okay, good. That would have made me look bad. So in March, what happened to the ratio? Right, it dipped way down to 0.7. And of course, with the benefit of hindsight, we can now say, man, that was a screaming buy opportunity, right? We should have begged, borrowed, and stole money to invest in the stock market back in March. If that happened again between now and the end of the year, and you're playing the interest rate game, that might cause you to think a little bit, right? The stock market goes way down, and we see this ratio down at 0.7, meaning prices are way lower than they should be. Prices are way lower than what Morningstar thinks the companies are actually worth. The fair value estimates might be a good buying opportunity. Okay. Now, of course, your 401k accounts are kind of subject to these machinations every day, right? Because the 401k is already invested, right? So good opportunity to kind of make some adjustments to your 401k if you'd like. Hopefully you didn't change anything back in March. Hopefully you didn't bail out of stocks. If indeed you you feel like you are at a place where you're kind of comfortable with your 401k value and you don't want to see it go through another March, this is a pretty good time to maybe take some chips off the table because the market's come back quite a bit. Long term, we're stock market optimists. It's also worth noting that, so we don't believe in bailing out of stocks completely. We think that stocks are probably the best way. They're imperfect, right? Because they move around a bunch, but we think they're the best way to build and preserve your wealth over a long period of time, 5 to 10 plus years. Just because you're retiring doesn't mean you're now a short-term investor, because you've got many years ahead of you. So you're still a long-term investor. You can still think long-term. So we're still believers in stocks. We don't advocate bailing out of them. But if you're 100% stocks in your 401k and March was really uncomfortable, maybe you dial it back to 90 or 80. Okay, that's something we can help you think about as well. But it is worth noting for all of you that your portfolio is not as aggressive as you might think it is. And what I mean by that is you've got a 401k. That's the one you see every day. If you log in every day, I don't recommend it. I don't look at mine every day. But if you log in every day, the 401k is the one you see, right? You get constant feedback, daily feedback if you want it, on what your 401k is worth. Your pension, however, which is significant, right? It's probably hundreds of thousands of dollars, might even be worth more than your 401k in some cases. That's not invested at all. So if you look at your overall portfolio, 401k plus pension, it might not be as aggressive as you think it is. Because again, that pension lump sum is not invested. You've also got Social Security, right? Social Security has value to it. It's not a lump sum. You're not going to get Social Security as a lump sum. But we could calculate a lump sum based on an estimated life expectancy. Social Security, for most of you, is probably worth hundreds of thousands of dollars as well. You're not going to get it all at once, right? You get it over time. But that's another asset you have that's probably worth hundreds of thousands of dollars, assuming a normal life expectancy. And that's not in the stock market either. So just because your 401k is aggressive, maybe it's 80% stocks, 90% stocks, 100% stocks, doesn't mean your overall portfolio is really aggressive, because you've got other stuff that doesn't care about the stock market, pension, Social Security, okay, maybe some other things. All right. So this ratio is something we monitor very closely and could be relevant to the interest rate gain. Okay, good. Got a good question about severance here. Severance, it'll probably come to you as a lump sum. You can spread it out over time. So the enhanced SIP folks, they're getting 30,500, which is the normal SIP, plus another 50,000. In recent times, managers have gotten about 6 months of pay, 50% of pay, however you want to think about it as a severance. It's probably going to come to you as a lump sum. Even if you have the option to spread it out, that's not often a good idea. It can be a good idea from a tax perspective, because you spread the taxes over multiple tax years. But if it's your intention to claim unemployment, which is enhanced right now, right? The government's handing out another $600 a week through the end of this month, and there's a lot of speculation that program might be extended in some way, shape, or form. We'll see what Congress has to say. But if you're still receiving money from the company, that's going to reduce, if on an ongoing basis, that's going to reduce, if not eliminate, your unemployment benefits. Okay, so that applies to severance. That applies to the monthly annuity. Okay, so if you take the monthly annuity instead of the lump sum, that might impact your unemployment. If you take Social Security, if you're Social Security eligible when you retire and you take that, that might impact your unemployment as well. Okay, so these are all factors to consider. As far as what you do with your severance, it's really up to you. I think most people just take it and stick it in the bank. That's a pretty good idea. Have an emergency fund that makes sure you can maybe you use it to pay off some high interest rate debt, right? If you've got credit cards and things sitting out there that are charging you 10, 15, 20% interest, get rid of those things if you can. Knock those out. Your low interest rate debt's not bad. If you've got a mortgage at 3, 4%, that's not the end of the world. You don't need to necessarily rush off and pay that down if you don't want to. But paying off high interest rate debt's a pretty good idea. Sticking it in the bank. The benefit of putting in the bank, certainly if you have a big expense, you've got cash right then and there that you've already paid taxes on, right? Because the severance is fully taxable. So you end up with a net amount, net of taxes. Okay. Trying to think. It also gives you some conviction to remain invested, right? If you've got a good amount of cash sitting there, maybe you'll be less inclined to sell stocks when we go through downturns, because downturns happen and they're uncomfortable, especially when you're retired and you're paying closer attention to your portfolio than maybe you have in the past. Maybe cash gives you the conviction, the confidence to remain invested and stick it out through times like March. Although hopefully March doesn't become a common occurrence. That wasn't very fun. Okay, so that was a good question. Thank you for sending that in by email. Okay, and I'll just show you an example, and then I'll let you go. We're kind of at the 40-minute mark, so that's kind of a good time to cut things off. This is an example of a stock strategy that we manage for folks. Full disclosure, my own retirement account as well as my wife's is in the strategy you see here. This is a building block that we use. We call it our high quality strategy. It could be a component of your portfolio if you hire our firm after retiring from AT&T. And you'll notice a few differences right away. We would complement it with other stuff too. So we might say, you know what, let's hold aside 3 to 5 years of expenses and pretty safe investments like short-term bonds and things that don't move around a whole bunch. And then we'll put the rest in something like this, maybe with some complementary pieces. That's all an individual discussion. We're not going to recommend a specific portfolio in this forum. First thing you'll notice, there's individual companies here, right? Boeing's one we just added recently. Berkshire Hathaway, that's Warren Buffett's company, McDonald's, Apple, Walmart, Amazon, Starbucks. So we buy individual stocks. That's a little bit of a difference. So we're not using funds like you have in the 401k. It's a little bit of a different dynamic. Removes a layer of expense, which is kind of nice. So you're not paying a fund management fee. But perhaps more importantly, these are big companies with sustainable competitive advantages. We call them moats that we and Morningstar and others estimate to last 10 to 20 years, if not more. We're monitoring the fair values of these companies constantly. These are big companies that probably aren't going away, no matter how ugly the environment gets, okay, with everything going on. We're not trying to hit home runs anymore, right? When you retire, we're trying to buy companies that we're pretty confident aren't going anywhere. We'll replace them from time to time. We do make replacements from time to time. Usually it's because a company becomes too overvalued, but you know, the price gets too high relative to what we and Morningstar and others think it's worth. But this is an example of a portfolio that we might, or a piece of a portfolio that we might help you implement in retirement. And sometimes it's just nice to see the individual companies that you recognize. Sometimes that's nice because you know what you own. Whereas when you own a fund, it can be less clear, be less intuitive. Okay. Well, good. I'll let you guys go. I'm going to stop sharing my screen here in a moment. Again, I did record this. So in order to, there's a good participation, over 120 folks today. So that's great. Thank you for joining us. If you would like the recording, you can reply to the email we sent you. And I believe, hopefully our compliance folks don't smack me over the back of the head after this is done. I believe we can send it to you on a one-on-one basis. In order to send it out on a mass email basis, I think we need to put the video through compliance first, which takes some time. So just let us know. If you'd like to set an appointment, if you have questions, again, as easy as replying to the email that we sent you to join this webinar, or call our office, 630-232-8995. You'll get a human being. They've got access to my calendar, the calendars of other advisors at our firm, if you've got someone else that you're accustomed to talking to, and we can put something on the books. But hopefully this is helpful. It's a lot of information. So maybe just focus on one or two things that you take away from this conversation. And we'll be thinking good thoughts for all of you and your families in the months ahead. Okay, take care. Bye.